Today we are going to be talking about finance and behavior, investing in behavior, and before we move on to getting into the subject, deep diving into the subject, let us first understand that finance and behavior is something which goes back generations. It comes from our culture, it comes from where we are coming from, it comes from how we are brought up. Let's take a classic case for India, Marwadis. They come from an area which is arid, which compelled them to work together, which compelled them to herd together, which also made sure that everybody is working for each other. The most classic case of them being entrepreneurs comes from the fact of having an extremely fantastic corporate governance structures of Bade Buzurg, which allows them a line of credit from the risk-averse people to the people who are willing to take risks. So you would see most of them are entrepreneurs because the main framework is taken care of. The other side of looking into how behavior shapes us, probably I could be a good example, is I come from a traditional Maharashtrian family. We are essentially risk averse, we are loss averse, and we are conservative in the way in which we think. Having said that, why has this happened? Probably because everybody's understanding of risk and return is different. These are generic examples of understanding how the history of where you come from, the culture of how you're brought up, and the way in which you think about money makes you take decisions which could be termed as risky by somebody or absolutely not risky by somebody. So what could be extremely risky for a Maharashtrian could be absolutely not risky for a Marwadi. So why was this discussed? Probably to summarize how where one comes from shapes risk and reward and the way in which people work. Looking into this, why has this come into play? Because everybody inherently has a bias which needs to be taken care of. Behavior is more about introspection, behavior is more about understanding where you come from, and that is what actually leads to the returns that one would want in the portfolio, right? So at every stage in life, at everything that you do in life is filled with how you are as a person, the character that you have, which is, as I mentioned, shaped by the culture that you come from. And the same thing could also be very well applied to finance, because the decisions that you take are inherently based not only on just the practical aspects, but on the intangible aspects of behavior, which allows you to make sure that what decisions you are taking are the right ones. So if we move into understanding how finance and behavior come together, let's talk about something which is again a bias, where if I may ask you that what has happened during the 2000 crisis, do you really remember that? What has happened during the 2008 lemon collapse, do you remember that? All of this comes as part of a recency bias. A recency bias is when you tend to remember the more recent events more vividly than most. So we would take the COVID-19 pandemic as an example, talk about what it does, and take into consideration every small bias that has affected us during the COVID-19 pandemic. So we summarize a set of biases and we make sure that whatever we are understanding from them comes from the behavior that has stemmed due to our reactions to certain events which occurred. It might be different for different people, and that is essentially why behavior is so interesting. The most important bias which hit people during the pandemic was a loss aversion bias, which could easily and most simply described as और गिरने से पहले पैसा निकाल दे. This is something which comes from us having a survival instinct for the past 50,000 years. Loss aversion bias normally happens when people put in money not knowing what their plan is, and they exit not knowing why they're exiting. It leads to a permanent loss in capital. In fact, I have an entire list of biases with me which are going to help us understand how each and every one of them has affected us during the last year's pandemic. Loss aversion bias is something which is one of the most primary biases. It has a set of other biases which already cluster around it, and as we speak more and more about these biases, we will understand how they sort of cluster with each other and affect us in a larger, broader manner. The second bias which affects us most is an anchoring bias. When the markets were at 27,000 last year, it went back up. A lot of people, like believe me, a lot of people were anchored to say, वापस 27,000 आएगा, तब entry कर देंगे. What really happened is it never hit the 27,000 mark. But what happened to you was you were anchored to 27,000 and you could not take a decision. What has this moved you into? This is basically moved you into a position of not taking any decision because you are anchored to 27,000. What affected you with the anchoring bias now is called a status quo bias. A status quo bias is essentially a position where you are not ready to take any decision hoping something might happen. It's a classic case of wasting time and procrastination. It affects every one of us. It affects me as well. In order to overcome status quo bias, there are various ways to look at it. We will come to it as and when we describe my own biases and the way in which I deal with them. Moving from status quo bias is one of the best cases of having discussions over a cup of tea or over a cup of coffee, or having a nice conversation between friends, is when ये किया रहता था तो वो होता था. It's called a hindsight bias. I actually call it retrospective romance, because if you would have acted upon information at the time that it occurred, I think everybody would have been a billionaire. But it's something which just remains part of gossip. To say Bajaj Finance 3 रुपए में लेते थे तो अच्छा होता था. Very few people have bought it at that price. In fact, very few people have held it till now. So hindsight bias again runs really strong as part of the biases which affect us. The third or the fourth important thing that happens, I'm talking about 1, 2, 3 because they are separate clusters which affect us, is mental accounting. You treat the same amount of money, let's assume it's a salary, in a different way than the money which has come to you by a stock which has 2x or 3x or 4x. If you would have put money during the crash, it has multiplied those 3x times, but you treat it in a different way. You would treat one as hard work, you would probably treat the other as a jackpot because you don't know why it has gone up so significantly. Although the numbers are the same, what really affects us is the way in which we look at them. If you don't know how the money has come to you, you tend to splurge. And this is where mental accounting really takes charge of you. The other thing that also affects us, and this has happened after the markets went up, is something called as a regret aversion. It is the most common thing that you hear when you talk to people. पैसा डालना चाहिए था. अगर मैं पैसा डालता था तो कुछ ना कुछ तो होता था. Now, we moved from understanding loss aversion to regret aversion is just a journey from the markets being at say 27,000 to where they stand today. In all of this, if you look at what really has happened, is we keep talking about the things which have survived and the stocks which have gone up. Now, how does that affect us? It's called a survivorship bias. Survivorship bias, essentially the most simplest and the commonest example is the Sensex. It is there since the early 80s. What it really does, it's a compilation of the best and the largest companies, 30 of them, Sensex 30, put together. If you compare that with your own portfolio, you will see a few companies might not have performed, but the Sensex inherently looks perpetually surviving. So if we tend to look at companies which have performed, and that's what we normally do, over a period of time, you tend to forget that some companies have also failed miserably, and we really tend to avoid them. One more thing I think which is very India specific, I feel it is very generic, is the circle of competency bias. I would like to talk about this because as a country we are extremely heavily into real estate. We are extremely heavily into something called as fixed deposits. The circle of competency bias essentially disallows us to move out of our zone of comfort. It is something which needs to be overcome by having an understanding of what new information comes to us. Is it a good thing or a bad thing? It's a double-edged sword. If you really know what you're doing, I think you should stick to it, but let there be a thesis, let there be a plan, so that what you're essentially doing is following a plan and not getting into something which is hearsay, so that you tend to quench the biases and move into something which is great, right? Now, what also affects the circle of competency bias is something called as a conservatism bias, where we just fail to take in new information and act upon it. So let's take a simple example. If you want exposure to real estates, you could probably get into something like an REIT, or there are different ways to look at real estate. The fact that you're not ready to summarize what an REIT does as a quasi-rental asset is the conservatism bias, which is in fact affected by your circle of competency bias, and disallows you to get into something to participate in an asset class which is probably real estate but in a different manner. So what we are really trying to do here is to make sure that we are getting the right information processed in the right way. The last part, unfortunately, in all of this is where we see people talk about things very very easily, very very loosely, to say मैंने last year 50% कमाया, 70% कमाया, 100% कमाया. The name for it is as simple as that. It's called an overconfidence bias. There has to be a significant amount of time, efforts and money dedicated towards understanding how the markets are operating. Great people have spent a lifetime understanding them, and they are humble enough to accept that they still don't know much. What normally affects us in an overconfidence bias is the fact that you feel that the music will go on and on and on, which moves you into another bias which is called a gambler's fallacy, which makes you think that the same thing will continue to happen to you all the time. Now, to summarize all of this, I would probably like to take my own example and speak about how I take care of them. I have conservatism bias, I have loss aversion bias, and I have primarily status quo or a confirmation bias. The status quo and confirmation bias sort of runs together. Confirmation bias essentially means I try and find information which suits my belief. Till the time I don't find it, I don't do anything. That's the status quo bias. What I have done in doing all of this, I have flipped over. So normally the normal situation for me would be to not invest money. That was the status quo. I have flipped it over to say I'll invest money and not do anything about it. Conservatism bias is something which I've trying to overcome by getting to meet more and more people, trying to understand where they come from, what their views are, trying to put it into my risk reward perspective. And the most important thing which has affected me by far is a loss aversion bias. I have overcome it by just increasing my margin of safety from X to 2X, so that the extra money which I have a simple, clear, practical view following an investor policy statement of the CFA curriculum to put it across the correct asset class for the correct time horizon, so that I am rewarded in a way in which I would want to. It has been beautifully summarized by a study by Vanguard, because what I am speaking, although seems extremely esoteric and intangible, what we are really essentially capturing is a behavioral alpha. So Vanguard has pegged the compounded average growth rate for capturing one's behavior every year to be an astounding 230 basis points plus. If you are doing it in the right way, there is an obnoxious amount of wealth which you can do. The whole idea is to make sure that you are in charge of your behavior by making sure that you do the correct IPS following the CFA curriculum. The other part is also by making sure that you understand your own behavior, and by doing so, you continue to have feedback loops to decrease the distance between what you have thought of doing and what you are doing. If you are able to do all of this, you are essentially quenching the noise around you, and you are well on your way to making a significant amount of money. This would probably summarize the whole context of behavior around for people, and I really hope that you guys have enjoyed this video. Thank you so much.